The very basic and also essential tool of technical analysis is charting. Charts help us identifying recurring patterns of prices. There are several different types of charts, but the one we are going to focus on is candlestick chart, which is the most popular and used among traders. The reason this is the most useful is simply because it provides us with more information, and once we know how to read it, we know how to read the other types such as line charts and bar chart. So let's quickly go over what candlestick chart is and how you should read it. Candlestick, or as some refer as Japanese candles, are graphical representation of an asset's price. The way that the prices are organized allow us to easily identify trends, support and resistance areas, and developing advanced indicators based on the presented data. As you will now see, candlesticks show us an information about price within the relevant time frame and the relationship between the open, close, high and the low prices. Basically, there are two main types, a bull candle and a bear candle. There is also another type, which is a neutral candle, but we'll get into it later on in this course. A bear candle, usually marked in red, represents a bearish pattern. It is used when the closing price is lower than the opening price. A bull candle, on the other hand, usually marked in green, and is used when the closing price is higher than the opening price. In addition to that, the candlestick provides us with information regarding the price fluctuations within the time period it stands for. Okay, so let's see how it looks like and how easily we can get the kind of information that we want out of it. Here you can see a bull candle. For our example, let's assume that it represents a time period of 1 hour. What we can see here is the opening and closing prices, as well as the highest and lowest levels that the price reached. The green part is the body of the candle, and we also have upper and lower shadows above and below the body. So here is what you need to know. Open is where the price was at the beginning of the hour, while close represents the closing price. This is what the price was at the end of the hour. Low reflects the lowest level, and high is for the highest price that was recorded during the same time period. Very simple. The same applies with the bear candle, only with one small difference. This time the price was dropping, so naturally the opening price is higher than the closing price. All the other parts are exactly the same. Now we are ready to go further and start learning about different price patterns.